Okay, we are starting some new material. We're starting chapter 22 on budgets, preparing various types of budgets. But before we begin to look at the Hayes Company master budget, let's talk a little bit about what budgets are. Remember, the focus of managerial accounting is to plan for the future, getting ready to see whether we have profit or loss, what the year is going to look like. So financial accounting was recording what happened last year or last quarter through recording transactions via journal entries. But managerial accounting is planning for the future using estimates to see what the year will look like. The process is to look at historical information and through various cost formulas that we've talked about in the past, estimate revenue, quantity times price, right? Sales revenue would be number of units we think we're going to sell multiplied times the sales price per unit. That's total revenue. And then our various costs will be estimated as well, understanding that some costs are variable, some costs are fixed, and there's others that are mixed cost. So again, using quantity and price assumptions, we will estimate our costs and expenses for running our business. Ideally, we end up with two documents. One is a projected or estimated income statement, sales revenue minus expenses equals net income. And secondly, we would be preparing a cash budget showing cash collected, cash dispersed, determining if we have enough cash to pay our bills. We're going to be looking at many budgets in order to pull this all together. Again, remembering we are a manufacturing company where we have sales revenue, and then we have our product costs. Our product cost is direct materials, direct labor, manufacturing overhead. We need to estimate all of those costs. And then we need to think about selling administrative expenses and how all those come together. Again, the goal is to project revenues and expenses and to project cash flows. What I would like to do in this recording is to look at the Hayes Company Master Budget, which is in your textbook. And I also sent it to you via Sakai. You have the first page of which is the master budget assumptions, which I have summarized, and then a whole series of budgets. Now, what I'd like to do is have you have that information in front of you, and then we'll discuss it. I will discuss it as we go through it. I will try to share my screen with you and show you the various budgets as we go through them. So let me see if I can do this now. Try to share the screen, bring it up. Should be this one here. Share. And if I can bring this over here, it'd be even better so I can see what's really going on. I hope that's what you can see here. Okay. So what you're looking at now is the Hayes Company master budget assumptions. You have sales assumptions, production assumptions, direct materials assumptions, etc. So the very first question a company has to ask itself and answer is how many units do they think they're going to sell? Again, it's an estimate. A company looks back in the past, how many units did we sell last year, to attempt to determine how many units they're going to sell going forward. We're going to prepare a Hayes Company master budget for 1 year. We're going to break it down on a quarterly basis. Let's look at the sales assumptions. The sales assumption, again, you're looking for quantity and price. How many units, the quantity, price, sales price per unit. This company is assuming that they're going to sell 3,000 units in the first quarter, plus 500 more each subsequent quarter. So 3,000 units in the first quarter, and the sales price per unit is estimated to be $60 per unit. So let's take a look at the sales budget, and that's what you see here. You see my cursor, sales budget, and this is the Hayes Company, and you can see they have first, second, third, and fourth quarter, and for the entire year. Let's look at that first quarter. The expected sales in units is 3,000 units, and the sales price per unit is $60 per unit. Their estimated sales revenue for the first quarter is $180,000. They do the same thing for the second quarter, the third quarter, and the fourth quarter. They have total revenue for the entire year at $900,000. Please keep in mind, this is based on sales, has nothing to do with collections. Remember the definition of sales when we use the accrual basis method of accounting? It's when title transfers. When we sell the product, we debit accounts receivable, credit sales revenue. There's no impact in cash until a later time when the customer pays the bill. That's our sales budget. Again, first quarter, they think they're going to sell 3,000 units. So the next question becomes, how many units do they produce? If they're going to sell, if they expect to sell 3,000 units in the first quarter, how many units do they need to make? The goal is to make more than you need. Now, why would you make more than you need? Well, just in case there's an unexpected demand for your product. If you only make 3,000 units and a customer comes along and wants to buy some other units, you won't, if you've sold all 3,000 units, they're gone. So you want to make more, just in case there's, again, as I said, unexpected demand for your product. How many more? How much more? Well, you don't want to make too many more, but you want to have enough. So we're going to prepare a production budget, and that production budget will give us an idea how many units we need to make. This company here, their assumption, Hayes, says the production desired ending inventory is 20% of the following quarter's sales. So they want to have inventory on hand just in case. Let's look at the production budget. Again, here's the production budget, Hayes Company. Let's look at that first quarter. Expected unit sales, we saw that from the sales budget, 3,000 units. And here's the line 7, add desired ending inventory. Remember the assumption, 20% of the following quarter's sales. So if they expect to sell 3,500 units in the second quarter, 20% is 700 units. We're going to add that to the expected sales. If a company is going to add for desired ending inventory, we also need to consider the inventory at the beginning of the quarter. So we will always add the desired ending inventory and subtract the beginning inventory. So here they have a number of $600 for the beginning inventory. The question is, where does that come from? And what you want to think about, remember, if we're looking at a budget here for the year ended December 31st, 2022, there is a fourth quarter here, fourth quarter 2021. And in that fourth quarter 2021, there was a desired ending inventory for the fourth quarter 2021, which was based on 20% of the following quarter's expected sales, which would be the first quarter. 3,000 units times 20% is 600 units. In other words, it's 20% of the current month's expected sales. So again, always add the desired ending inventory, subtract the beginning inventory, and what you can see here, and again, we're just focusing on the first quarter. is that even though the company expects to sell 3,000 units, they're going to produce 3,100 units. And we're going to do that for the second, third, and fourth quarters as well. That's production budget. So now that we have the production budget, it tells us how many units we need to make each quarter. The question is, what is it going to cost to make those 3,100 units, 3,600 units, 4,100 units? What we need to look at is product cost, direct materials, direct labor, and manufacturing overhead. And again, we need assumptions to help us through that. What are the assumptions? Direct materials, we're going back to the assumptions page. Direct materials, quantity and price. 2 pounds per unit, $4 per pound. And again, the company wants to acquire more direct materials than they need, just in case. Just in case what? Just in case they have some mistakes and have to throw away some of those direct materials, just in case there is some contamination, just in case there is some spoilage, some of it doesn't work, there is some theft, whatever the case may be, they want to have more materials than they need, just in case. Because if they run out of materials, then production comes to a halt. But again, how much more? Well, we need an assumption. We need an estimate. They're saying here the desired ending inventory is 10% of the following quarter's production needs. Let's look at the production budget. The direct materials budget. Here it is here, Hayes Company direct materials budget. Again, they're starting with what? Expected units to be produced, which comes from where? The production budget. Here is our assumption, our quantity assumption. It takes 2 pounds of materials per unit, 3,100 units times 2 pounds per unit. They need 6,200 pounds just for the production units. But they want to have some extra, so they're going to have a desired ending inventory of what? Of 10% of the following quarter's production needs. 7,200 pounds times 10% is 720. I'm going to add that in. And again, if we're going to add desired ending inventory, we need to subtract the beginning inventory we began with. So again, it's 10% of what? 10% of the current month's expected production needs. 6,200 pounds times 10%, 620. I'm going to subtract that. The direct materials units to be purchased, 6,300 pounds. Now the price assumption comes into play, $4 per pound. For the first quarter, you can see $25,200 for direct materials. That's direct materials. What's next? Direct labor. Next component of product cost is direct labor. And we have our assumption here, quantity and price. It takes 2 hours per unit to make one of these things. And the price is $10 per hour. The labor rate is $10 per hour. Let's look at the labor budget. And that's right here at the very top of the screen, direct labor budget. Look what they start with. Units to be produced from the production budget, 3,100 units. The quantity assumption, 2 hours per unit. They need a total of 6,200 hours. The labor rate, $10 per hour. For the first quarter, it's going to cost $62,000 in direct labor. Fairly straightforward budget. Quantity and price. That's direct labor. Next component of product cost is manufacturing overhead. And as you recall, manufacturing overhead tends to be a mixed cost. What does that mean? It has a variable and a fixed component. Let's look at the assumption. The variable cost is $3 per direct labor hour, and the fixed cost is $38,500 per quarter. Now, here is where a company develops its predetermined overhead rate. Let's remember the formula for predetermined overhead rate. Total estimated manufacturing overhead dollars divided by total estimated activity base. In this case, direct labor hours. So in addition to this budget, the manufacturing overhead budget, calculating the total expense for manufacturing overhead, we have the opportunity to calculate the predetermined overhead rate. Let's look at this budget. Hayes Company, manufacturing overhead budget. Remember, mixed cost, variable plus fixed. The variable rate is a function of direct labor hours. And we said it was $3 per direct labor hour. So why are all these lines in here? Oh, just to make it confusing. But if you add up indirect materials at $1, indirect labor $1.40, utilities at 40 cents, maintenance at 20 cents per hour, it adds up to $3 per direct labor hour. First quarter again, 6,200 direct labor hours times $3 an hour, $18,600 in variable cost, plus $38,500 of fixed costs. Yes, they go through the process of adding a lot of detail, but the formula to estimate manufacturing overhead is $3 per direct labor hour plus $38,500 per quarter. Variable plus fixed equals total manufacturing overhead, $57,100. Now, as I mentioned, you can calculate the predetermined overhead rate here. Again, what is that? Total estimated manufacturing overhead expense for the year divided by the total activity base for the year. Let's look over here. You've got your total for the year. You've got $92,400 of variable, $154,000 of fixed, for a total of $246,400 of total manufacturing overhead expense, divided by the denominator value, direct labor hours, 30,800. Predetermined overhead rate is therefore $8 per direct labor hour. That's manufacturing overhead. Let's look at the next item, selling and administrative expenses. Again, this is a mixed cost, which includes both variable and fixed. What is the assumption? Variable cost, $4 per unit sold, plus $30,000 per quarter. Let's look at selling administrative budget. Hayes Company, selling administrative expense budget. Again, first quarter. You got all 4 quarters in the year, but we're just going to look at the first quarter. Starts with what? Budgeted sales in units. Why? Because the variable cost is $4 per unit sold. Okay, they break it down, sales commission and freight. 3 plus 1 is 4. 3,000 units sold, $4 per unit, $12,000 in variable cost, plus $30,000 of fixed cost. Yes, they break it out, they give you a lot of detail, but again, the formula was $4 per unit sold plus $30,000 in fixed cost. Total expense, variable plus fixed, $42,000 or $180,000 for the year. Let's go back to the next item. At this point in time, we can calculate a cost per unit. What does it cost per unit to manufacture this product? Materials, labor, and overhead. Let's take a look at the product cost card, which is right here. Computation of total unit cost. Again, materials, labor, and overhead, quantity and price. Materials, 2 pounds per unit, $4 per pound, $8 per unit. Direct labor takes 2 hours to make it. The labor rate is $10 per unit. Unit cost, $20. Now watch out for this one, manufacturing overhead. In our example, manufacturing overhead is applied on the basis of direct labor hours. So again, we use the same 2 hours, this is important. In the unit cost, the predetermined overhead rate. Maybe I should have written it here, but I would say you might want to write in here, the predetermined overhead rate is the unit cost, 2 hours times the predetermined overhead rate, which is $8 per hour, $16. Therefore, it costs $44 per unit to manufacture this product. Let's think about it. Let's go back. The sales price per unit, $60 per unit. The product cost per unit is $44 per unit. $16 per unit in gross profit. So at this point in time, we can prepare a budgeted income statement on the accrual basis method of accounting. Okay? Sales, $900,000. That comes from that very first sales budget, but it's also what? 15,000 units times $60 per unit, or $900,000. Cost of goods sold, 15,000 units. Remember the matching principle. If you sell 15,000 units, product cost also has to be based on 15,000 units. 15,000 units times a product cost of $44, $660,000 of cost of goods sold. Gross profit, therefore, is $240,000. We calculated selling administrative expense here at $180,000. That's where that number goes. Income from operations of $60,000. Let's not worry about interest expense or income tax at this point in time. But you've got a budgeted income statement. They're making a profit. What else do I need to worry about here? Let's go back to our assumptions. We did the cost per unit, the product cost. Now what do we want to look at? We want to look at the cash budget. Another important document. Answers the question, do we have enough cash when needed to pay the bills? If the answer is yes, no worries. If we come up short, what does a company need to do? They need to plan to borrow some money to make sure they have enough cash to pay the bills when they come due. Here are some assumptions. Remember, there is a difference between recording the sale and collecting the cash from the customer. So we need some assumptions. Cash collections. Cash collections from customers. 60% is collected in the quarter of sale, 40% the following quarter. That's cash collections. Let's look at the cash collections budget. That's here on this page here, collections from customers. What cash is collected in the first quarter? Well, let's remember, this is the budget for the year 2022. At December 31st, 2021, there is some uncollected sales. They told us in this problem that $60,000 was in accounts receivable at 12/31/21. That's 40% of some number. That's $60,000 collected in the first quarter. What else is collected? 60% of the current quarter's sales. Current quarter sales from the sales budget, $180,000 times 60% is $108,000. First quarter, they're going to collect $168,000. Take a look at second quarter, third quarter, and fourth quarter, same scenario. Those are cash collections. Let's look at cash disbursements. Direct materials. Direct materials, 50% in the quarter of purchase, 50% in the following quarter. Let's look at cash disbursements for direct materials. First quarter disbursements. At 12/31/21, they had accounts payable of $10,600. That's 50% of some number. Got $10,600 collected in that first quarter, plus what? 50% of the first quarter's expense for direct materials. So they're going to disperse $23,200 in the first quarter, $27,200 in the second quarter. What else do we need to know before we pull together the cash budget? Well, it doesn't say it here, but direct labor is paid in the current quarter. As it's expensed, it is paid. Goes on to say, manufacturing overhead and selling and administrative expenses, subtract depreciation expense to arrive at the cash dispersed. What does that mean? Part of the manufacturing overhead budget, you can see it here, included depreciation of $3,800 per quarter. That is an expense, but it's not a cash disbursement. Let's remember the definition of depreciation expense. Allocation of the cost of an asset over its useful life. It's an allocation. It's not a cash disbursement. Let's remember the journal entry to record depreciation expense. Debit depreciation expense, credit accumulated depreciation, no impact on cash. And thirdly, let's remember that when we prepared the statement of cash flows, we always added back non-cash expenses. The one that we focused on was depreciation expense. Therefore, depreciation expense is a non-cash expense. If we're preparing a cash budget, we need to subtract. We need to make sure that depreciation expense is not included in cash dispersed. Let's look at the cash budget. Seems a bit overwhelming, but it really isn't. First quarter. Now, a basic format for, let me get a tablet and write on it. The basic format for the cash budget, and I'll show you this in a second. Beginning cash plus cash collected minus cash dispersed equals cash let me correct this. So I don't know if you can see that. I think you can. This is the basic format for the cash budget. You're going to start with beginning cash, going to add cash collected, you're going to subtract cash dispersed, and you'll have ending cash. That is the basic format of the cash budget. Now, we're going to see a little bit more detail added to it. Let's look at the Hayes Company budget. First quarter, beginning cash, $38,000 given to you. And then they have some cash collections from customers. That comes from the cash collections budget. And they sold some securities during the quarter. It's outlined in the problem. I'm going to add that as well. Beginning cash plus cash collections, they have available cash of $208. Here are all their disbursements, materials, labor, manufacturing overhead. Be careful. What is that? That is manufacturing overhead expense minus depreciation. Let's go back and look at that from the manufacturing overhead budget. The total expense is $57,100, but that includes $3,800 of depreciation expense, non-cash expense. You need to subtract depreciation expense from that number. So you can see here Manufacturing overheads 53.3, which is the total expense of 57,100 minus depreciation of 3,800. It's outlined down here, by the way. 53.3. Same thing with selling administrative expense. There is some depreciation in that number. Down here, the expense is 42,000 minus 1,000 in depreciation. Selling administration expense is 41,000. The problem tells you that they pay $3,000 a quarter in income tax expense. So what do they have? They have cash available of 208 minus $182,500. They have excess cash of 25.5. What does that mean? Well, they've got cash left over. Is it enough? Let's go back to their assumptions. Their minimum cash balance is $15,000 at the end of any quarter. If they have more than $15,000, not a problem. If they have less than $15,000, they need to borrow some money because they want to make sure they have a sufficient amount of cash available. So in our first quarter, they've got plenty of cash. Let's look at the second quarter. Now in the second quarter, the beginning cash comes from where? Ending cash in the first quarter. 25.5 becomes 25.5. And we do the same thing. Add collections from customers. Here are all the disbursements we make. Ending cash now is only $12,000. They wanted to do what? They wanted to make sure they had at least $15,000. In order to get there, they have some borrowings. They're going to borrow $3,000 to get to the ending cash of 15. Third quarter, beginning cash becomes that same 15,000. They go through the same process. Add collections, subtract disbursements. They now have what? Plenty of cash. They have more than $15,000, and they can do what? They can repay the $3,000 plus some interest of $100. Cash budget, again, answers the question whether they have enough cash to pay the bills when the bills come due. If they don't have enough cash, you need to make provision in order to make sure they have enough cash. Borrow the money to increase the cash account. So those are the various budgets that you are responsible for. We're going to augment this with some homework problems that I will assign. There'll also be some Wiley Plus problems that you can work on. So there you go. Thank you very much, and we'll talk to you soon.